Stop watching the stock market for the next crisis. The first warning is when your bank delays transfers, raises holds, or updates policy overnight, quietly. And the early phase is already visible if you know where to look. The pressure building in the financial system isn't starting on the floor of the New York Stock Exchange. It isn't kicking off with panicked traders and seas of flashing red. It's starting quietly, perhaps with an email from your bank, inside the one building you trust most with your money. Because as the system adjusts, the first piece showing strain isn't stocks or even real estate. It's your local bank. Deposits are being exposed to a volatile interest rate system, and we're about to uncover why a massive global mountain of debt makes your bank account ground zero for the current instability. If you're the kind of person who suspects the real story isn't the one on the evening news, you're in the right place. For years, we've been told to watch the stock market as the ultimate sign of economic health. We follow the Dow, the S&P 500, the NASDAQ, thinking they hold the secrets to our financial future. But that's a dangerous illusion. The real story, the one that decides whether you can get cash from an ATM or if your life savings are safe, is happening behind the quiet, unassuming doors of the banking sector. We are living in the biggest debt bubble in human history. The numbers are so huge, they almost feel fake. In late 2025, the IMF reported that total global debt was sitting at just over 235% of the world's entire GDP. Think about that. For every dollar of economic value created on the planet, there are more than $2 of debt tied to it. This isn't just a number. It's a lit fuse, and the global banking system is sitting right on top of it. We're told that the US economy in 2026 looks steady, that inflation is cooling, and that we've dodged a recession. But the real risks haven't gone anywhere. They've just been buried under layers of debt and complicated finances. Today, we're showing you the sequence of failure, the chain reaction where the early phase is visible long before the stock market even gets the memo. And it all begins with the first, most critical domino, the banks. So why are banks the first to break? The trouble starts when interest rates go up, which is exactly what's been happening. Suddenly, those long-term assets the bank is holding, those safe government bonds, start to crash in value. A bond paying 2% isn't very attractive when new bonds are paying 5%, so its price has to fall. This creates what the industry calls unrealized losses. The loss isn't real yet because the bank hasn't sold the bond, but the hole in its balance sheet is very, very real. Here's the part most people miss. The system already showed us this exact failure mode in 2023. It's exactly what killed Silicon Valley Bank in March of that year. SVB was loaded up on long-term government bonds. When the Federal Reserve hiked rates at a historic pace, the value of those bonds cratered. When customers started pulling their money out, SVB was forced to sell those bonds at a massive loss. The second that loss became real, panic took over. A digital bank run pulled $42 billion out in a single day. It was a textbook case of the first domino falling. What happened to SVB is possible because of a fatal flaw baked right into their business model. They borrow short and they lend long. Think it through. You deposit your paycheck, that's money you can ask for back at any second. For the bank, that's a short-term liability. The bank then takes your cash and lends it out for a 30-year mortgage, or uses it to buy a 10-year government bond. That's a long-term asset. When times are good, this works perfectly. But when rates rise, as we just saw, it can be a death sentence. And SVB wasn't alone. It was a symptom of a system-wide sickness. By the end of 2024, unrealized losses on securities across FDIC-insured banks were still massive. This is the dry tinder. It means hundreds of banks are sitting on paper losses that can become catastrophic the moment they're forced to sell to meet withdrawals. The failures in 2023, which also took down Signature Bank and First Republic, were a wake-up call. They showed how vulnerable regional banks are, and the failures haven't totally stopped. While 2024 and 2025 each saw only two FDIC-insured bank failures, a Chicago-based bank, Metropolitan Capital Bank and Trust, became the first casualty of 2026. Regulators shut it down in late January due to unsafe and unsound conditions. Each failure, no matter the size, sends a tremor of doubt through the system. It reminds people that their money is only as safe as the assets their bank holds. And right now, a big chunk of those assets are underwater. This is why the banks crack first. They are the most sensitive to interest rates and the most reliant on one fragile thing: your confidence. Once that's gone, the cascade begins. The bank's weakness is the detonator, but the explosive charge is the mountain of debt that has flooded every corner of the economy. The scale is hard to wrap your head around, but you have to understand it to see how fragile everything is. Here's the shift. Debt only looks harmless when rates are stable. When rates move, debt turns into a monthly payment shock. That's why this isn't a stock story, it's a refinancing story. And refinancing is where systems break. As of late February 2026, the US national debt was screaming past $38.7 trillion and on track to cross $39 trillion by April. It's growing at a pace of over $6 billion a day. Sliced up, that comes out to over $115,000 for every single person in the country. The Congressional Budget Office projects that debt held by the public will hit 120% of GDP by 2036, a level not seen since the end of World War II. Why does this matter? Because someone has to buy all this debt. And as the debt grows, the interest payments explode. Net interest on the debt is projected to eat up nearly 14% of all federal spending in fiscal year 2026. That's money that can't be spent on anything else, and it forces the government into a doom loop of issuing new debt just to pay off the old. It's not just the government. The private sector is also drowning in leverage. U.S. non-financial corporate debt reached over $14 trillion by late 2025. For years, cheap rates let companies borrow money for practically nothing to fund stock buybacks and expansion. Now, they have to refinance that debt in the real world. A loan that costs 2% now costs 5 or 6% to roll over, which squeezes profits and forces companies to cut costs, starting with jobs. And then there's us. As of the end of 2025, U.S. household debt hit a record of nearly $18.8 trillion. That's mortgages, auto loans, credit cards, and student loans. This debt sits with families who are already stretched thin. A Bank of America report analyzing 2025 spending data found that nearly a quarter of U.S. households are spending over 95% of their income just on necessities. Other surveys based on how people feel show even higher numbers, with some suggesting over half of all Americans report living paycheck to paycheck. There is virtually no cushion for a financial shock. This is the backdrop. A world saturated with debt, a U.S. government borrowing at a frantic pace, corporations hooked on cheap credit, and a consumer stretched to the absolute limit. This huge pile of debt makes the whole system incredibly sensitive, especially when rates move. If you're still watching headlines, this will sound like doom. If you're watching plumbing, it's just mechanics. If bank fragility is the detonator and debt is the explosive, then interest rates are the trigger. For more than 10 years after 2008, the world ran on free money. This zero interest rate policy, or ZIRP, is what fueled that massive buildup of debt we just talked about. It pushed investors into riskier and riskier assets just to get some kind of return. It created a global everything bubble. Then came the inflation shock of the 2020s. Central banks, led by the US Federal Reserve, had to slam on the brakes, launching the most aggressive rate hiking cycle in modern history. This is the moment everything changed. The tide of free money went out, and we're only now seeing who was swimming naked. The The rate spike is the second domino because it directly attacks the first two weak points. First, as we saw with SVB, it crushes the value of the long-term bonds on bank balance sheets, creating those huge unrealized losses. Every tick higher in interest rates digs that hole deeper, eating away at the capital banks need to survive. The Fed is caught. Does it fight inflation by raising rates, or protect the banks by cutting them? Persistently high inflation demands higher rates, but higher rates crack the banking system's foundation. Second, rising rates turn that mountain of debt into a weapon. Every government, every company, and every person with debt that needs to be refinanced sees their interest costs explode. A US government that could borrow for cheap now faces much higher costs, speeding up the debt spiral. Companies that have to roll over their bonds find their interest payments have doubled or tripled, putting huge pressure on their business. This is how a liquidity problem, not having cash on hand, turns into a solvency problem, also known as bankruptcy. This is where the mainstream narrative gets it wrong. They focus on the stock market, but the pressure building in the credit market is what matters. Just look at the maturity on US debt. As of early 2026, about a third of all publicly held marketable debt was set to mature within just 12 months. That's trillions of dollars that have to be refinanced at today's higher rates. The party of cheap money is over. This process also flips the yield curve, a classic recession signal where short-term interest rates are higher than long-term ones. This is poison for banks, as it guts their borrow short, lend long business model. It forces them to tighten lending standards, creating a credit crunch that starves the rest of the economy of capital. Even though many economists in early 2026 think the Fed will start cutting rates, a lot of the damage is already done. The system has been reset to a new, harsher reality. And if inflation stays sticky, which some analysts worry about, the Fed is losing its ability to cut rates as much as the market wants. Any surprise inflation forces their hand, triggering another rate spike and sending new shockwaves through the banks. Inflation isn't just a cause of the problem, it's an accelerant. It's what forced the Fed's hand to raise rates in the first place, setting off the unrealized loss crisis in the banks. But its effects run much deeper, creating a nasty feedback loop that traps the average person and circles right back to the banks. While wages have gone up some, for many people they haven't come close to matching the jump in the cost of living. Even as the headline inflation number cools, the prices for things you actually buy, groceries, rent, insurance, haven't gone back down. They've just leveled off at a much higher place. Recent data paints a pretty grim picture of consumer health. As mentioned, a Bank of America report found that in 2025, nearly a quarter of US households were spending more than 95% of their income just on essentials. They have next to nothing left over. This financial stress leads to a direct and dangerous consequence for the banks: rising delinquencies. When people can't make ends meet, loan payments are often the first thing to get missed. The early phase of this is visible in auto loans and credit card debt. As pandemic-era savings run out and costs stay high, more and more people are falling behind. Every missed payment is a loss for the bank that issued the loan. This is where the cycle gets really vicious. Banks, already weak from losses on their bond portfolios, now start to see their loan portfolios go bad too. Their capital, the buffer against losses, is now getting hit from two sides at once. In response, banks do the only thing they can. They pull back. They tighten lending standards, making it harder for both people and small businesses to get a loan. This is a credit crunch. The family looking for a mortgage gets turned down. The small business owner trying to get a loan to make payroll is denied. This chokes off the economy, leading to slower growth and eventually job losses. And job losses, of course, are what really breaks the consumer. People who lose their jobs can't pay their mortgage, their car loan, or their credit cards. This kicks off a new, even bigger wave of defaults, which hammers the bank's balance sheets, forcing them to tighten lending even more. The cycle feeds on itself, bleeding from Wall Street out onto Main Street. If this all sounds familiar, it should. History doesn't repeat itself, but it sure does rhyme. The pattern of massive debt, rising rates, and fragile banks is a story as old as money itself. We've seen this movie before, and every time we tell ourselves that this time is different. The most obvious parallel is the 2008 global financial crisis. The details were different. Subprime mortgages instead of government bonds, but the mechanics were identical. Banks loaded up on what they thought were safe, high-yield assets. Credit exploded, fueling a housing bubble. When the Fed started raising rates, the bubble popped. Mortgage defaults soared, the value of those safe assets evaporated, and the balance sheets of giants like Lehman Brothers and Bear Stearns were destroyed. The first dominoes weren't the stock market. They were the over-leveraged financial institutions. Go back further, to the savings and loan crisis of the 80s and 90s. The S&Ls were basically banks with that classic borrow short, lend long model. They took customer deposits and issued long-term, fixed-rate mortgages. Then, the Fed, led by Paul Volcker, jacked up interest rates to kill the runaway inflation of the 70s. The S&Ls were trapped. The interest they had to pay on deposits shot up, while the income from their old, low-rate mortgages stayed flat. Their business model was wiped out, leading to the failure of over a third of all S&Ls in the country. It was the exact same interest rate problem banks face today. We can even see echoes in the Great Crash of 1929. The Roaring '20s were a time of huge credit expansion. But under the surface, the system was cracking. The real damage wasn't just the crash itself. It was the wave of bank failures that followed. Between 1930 and 1933, over 9,000 banks failed, taking the life savings of millions with them and pushing the country into the Great Depression. The lesson, again and again, is that a stock market crash is usually a symptom of a deeper banking crisis, not the cause. If this analysis gave you a clearer picture, send it to one person who needs to see it. But we're not done. In the final section, we'll map the full modern cascade and uncover the hidden multiplier most people never price in. So let's put it all together. The sequence of a modern financial crisis is a devastatingly logical chain of events. First, the banks. Weakened by their flawed business model and sitting on huge unrealized losses, they are the system's most fragile point. Second, the rate spike. It acts as the trigger, attacking the bank's balance sheets and making the mountain of global debt crushingly expensive. Third, the credit crunch. Scared of more losses, banks stop lending. This is the moment the problem escapes the financial world and infects the real economy. Fourth, the consumer. Squeezed by inflation and now facing a tougher job market and no credit, households start defaulting on loans, which feeds the cycle right back to the banks. Finally, the asset price collapse. The stock market crash that everyone watches for isn't the start of the pressure building. It's one of the last and most visible results of a rot that began deep inside the banking system. And then you hit the part nobody can see on a chart. The contracts underneath everything. But there's one more layer to this story, the hidden dangers. Lurking in the shadows is the derivatives market. These are essentially side bets on where interest rates, currencies, and other assets will go. The total value of these contracts is astronomical. A Bank for International Settlements report from mid-2025 put the notional value of outstanding over-the-counter derivatives at a staggering $846 trillion. This is a tangled web of interconnected IOUs between all the major financial players. No one knows exactly who owes what to whom. In a crisis, when one major player fails, it can set off a chain reaction of defaults through this web. This is what turned the Lehman Brothers failure in 2008 from a big problem into a global catastrophe. The derivatives market is a hidden risk multiplier. capable of spreading the damage from a single bank failure across the entire world. So when we ask what breaks first, the answer isn't a market. It's an institution. It's the bank. They are the linchpin of the whole system. But their very design has a fundamental flaw that gets brutally exposed in a world of record-breaking debt and rising interest rates. The story of the system adjusting isn't a mystery. It's a predictable sequence we've seen play out through history. It starts with the banks, gets triggered by interest rates, is made worse by debt, and is ultimately passed on to all of us through a painful credit crunch and job losses. The real question isn't just about money, it's about trust. The system runs on our collective belief that the numbers are real and the institutions are sound. The early phases of this adjustment are testing that belief, and the outcome will define the next decade. The challenge today is that the scale of everything is completely unprecedented. The debt is bigger, and the system is more interconnected than ever before. The true test is whether policymakers can see the cracks that are forming right now in the very foundation of the system before that first domino starts to fall. Because when it does, the cascade will be fast and unforgiving. The first break is the one that matters most, and it's happening closer to home than most people think.